So I don't know.
So it's not like hot racking in the military or like on submarines, where basically you like the second shift duty guy rolls out of bed and you basically lay in like a hot, bed, right? Isn't that what they call it?
I
Hot
don't think
racking?
Yeah,
that's
it's
it.
hot racking. Yeah, it's the same.
Yeah.
I asked the same question, Drew.
I don't think that's it. No.
Okay.
No.
All right. So it's not like third shift guy gets off and you sit down in the warm chair.
You
No.
go to the bathroom and somebody grabs your desk.
All right, so welcome to episode 82 of Farm to Markets. This is a show where participants only get 5 minutes to state their opinions, and the person with the most time at the end wins, but there are no prizes. Today we are talking about if now is the time to take Warren Buffett's advice, why the NASDAQ is outperforming the Dow, the IRS Tax Preparation Service, hot desking, and work-life balance of millennials. So institutional investors have pulled a net $33.9 billion from the stock market over the past 12 months, according to the S&P 500 Global Market Intelligence data. While individual investors have yanked another $28 billion, billions have flowed into cash equivalents like money market funds, driving total assets in the money market to a record $5.3 trillion as of May 10th, according to the Investment Company Institute. To some, all the doom and gloom looks like a sign of hope. Many on Wall Street view extremes in sentiment one way or the other as the time to do the opposite. Warren Buffett famously advised investors to be greedy when others are fearful. Do you think now is the time to take Warren Buffett's advice?
I mean, it really depends on what your goals are, what your risk tolerance is, what your investment time horizon is. So, if you were 64 and a half years old in 2008 when the market was crashing, that's not really a great time to retire if you had just lost 30-40% in your retirement account. So maybe it is. But if your accounts are holding up right now and you're 64 and a half looking to retire, it may not necessarily be the right time to pour more money into stocks. So it just depends on kind of what your goals are. If you have 30 years though, when the stock market is down 30, 40, 50%, it's a great buying opportunity almost every single time. Because when you buy a stock, let's say you buy the S&P 500 index tracking ETF from one of several big investment firms. In doing so, all you're really doing is placing a general bet that 30 years from now, the stock market will be higher than it is today. If you believe that it's going to be lower than it is today, we might have some bigger problems than whether or not your retirement account loses a little bit of money. So if you have the time, if you're, a younger worker who's just going to be pumping cash into your retirement account over the next 20 to 40 years, absolutely, it's a buying opportunity. If you're concerned about stocks declining and you're 64 and a half and getting ready to retire, maybe it's time to go to a more safe haven asset.
I don't like the words greed or fear, period. I certainly don't like to act on fear or greed. But I guess to Warren Buffett's point, being thoughtful and patient does allow investors to invest when stocks are on sale. And that's kind of what we're seeing right now. At least that's what the article was saying. But the article, it was really more of like a feel-good piece during this period of market uncertainty. I don't take it so much as a investment recommendation piece. Here at Coco Enterprises, we primarily work with investors focused on building sturdy long-term wealth, right? We're not big institutions. We're not pension funds. We're not trading on supercomputers. We're not making big bets on macroeconomic factors. So for the most part, for the average wealth building Joe out there, invest systematically. If you have extra discretionary income, yes, invest more when the markets are down, but don't change your investment strategy based on fear or greed.
Couldn't agree with Drew any more than basically what he said. It was well stated. I think the best way to make decisions is just follow the rules. And here at Coco Enterprise, we have a lot of rules. We've got our Wealth Builders Milestones, which kind of directs whatever extra cash we have right now. It basically tells us to pay off debt or save for a house or put money away for retirement or when to buy condos and those sorts of things. And secondly is that by following the rules, we want to have too much money in any one particular area. With the recent banking crisis, I think folks that who have all of their money in the bank thinking they're going to avoid, catastrophe. Well, I think that's foolhardy. I think you just follow the rules of making sure you don't have too much of a good thing in any one thing. Follow the rules. Don't worry. It doesn't add 1 minute to your life, and it certainly doesn't help your portfolios. So I think that what Warren Buffett is saying is that most people don't become wealthy. That's because most people don't follow the rules. Most people do act on fear or greed, and they make decisions which are not in their best interest.
I think Warren Buffett's advice is good when it's like March of 2020 and the S&P 500 is down 39% or 35% or whatever it bottomed at. But right now, the S&P 500 is up about 5% over the last 12 months. The NASDAQ is up about 10.5 over the last, 12 months. And before that, it was up, over the last 3 years, it's up 14%. It's up almost 15% over the last 5 years. I guess I don't know what they're talking about. Yes, like some people have moved money into the money market, but I'm not sure all of that came from the stock market. I imagine a lot of that came from treasury bills that came due, and people are freaked out about the debt ceiling, so they moved their treasury bill assets into money market stuff, or they had their stuff in long-term treasury bonds, and they sold those mutual funds and put them stuff in a short-term money market fund. So nothing right now is like screaming, everybody's afraid right now, like it was in like March of 2020 or 2008 or 2001. So I think I think the article is a little hyperbolic because I don't think people are freaking out. And Warren Buffett is famous for saying, buy when there's blood in the streets. There's no blood in the streets right now. So I would just turn your enthusiasm to simmer and just keep doing what you're doing because it's not that bad.
Tell that to Glacier Bank.
Yeah. Okay. Yeah. So there are a few things out there. Also, I'll point out as I forgot to start recording the clock. So it's going to be a little, so people aren't seeing it on there. It's because I forgot to hit record. I just hit it, so it should be on there now. So, all right, where are we at here? All right, so number 2, the NASDAQ composite is now leading the Dow Jones Industrial Average by 18.3%. Its widest margin of outperformance since 1991 as of Tuesday's close, while the blue chip gauge erates its year-to-date gains. So the Dow is down year-to-date, according to Dow Jones market data. What do you think is happening? Why is the NASDAQ so outperforming the Dow Jones Industrial by such a large amount?
Well, I don't think it's too much more complicated than tech had a really bad year last year, and this year they're bouncing back. A lot of businesses really struggled, tech businesses in particular, after the money shower stopped spraying them with cash at the end of the COVID era. People started going back to the offices. So all these tech companies that were having a bonanza when everyone had no choice but to work from home, and the government's handing out money like it's Halloween candy. Now all of a sudden they have to kind of go back to normal. And like I said, last year they had a really bad year, and this year they're coming back. And for each individual stock, you might see something different going on. Like Tesla lowered their prices for cars, for example, so that they can try and sell more, but also capture federal subsidies. That's not going to necessarily be the same thing for a company like Apple, that's also had a pretty good year, that expects to sell more now that they believe, in some cases anyways, that Chinese consumers are going to be buying more Apple products again now that they're no longer locked inside their homes. So there's different reasons for different companies, but in general, tech had a terrible year in 2022. 2023 is a bit of a bounce back from the lows towards the end of last year.
Yeah, I agree with Alex. Nothing supernatural going on. Stocks are cyclical, markets are cyclical, and they change based on economic factors. Back in 2022, like Alex said, the NASDAQ just got hammered. It severely lagged the S&P 500 and the Dow. The Dow was still down, but it was still performing better than the two other indexes. Remember, inflation was high. The Fed was jacking up interest rates, and investors mostly ditched tech and put money into safer blue chip dividend-paying stocks like Johnson & Johnson, Coca-Cola, McDonald's, Walmart, those sorts of things that are in the Dow. Well, the environment's changed. Interest rates are starting to trend down, and the Fed is anticipated to reverse rate hikes, which is good for growth stocks. And traditionally, when markets rebound after a slump, growth stocks see the rebound before. We got a taste of that in November. I think it was on the 10th. Got the CPI data. It came in lower than expected, so growth stocks popped, and that was primarily tech. Investors got the risk on mindset and changed their holdings from that point forward. So this makes sense. Investors tend to pile into growth stocks at the beginning of a rally because those are the ones that have fallen the furthest during the bear markets and therefore have the most to gain during these recoveries. And that was certainly the case in 2022. And I guess one more thing to add is 20% of the Dow Jones is held in financials. And financial stocks certainly didn't benefit from the banking drama that we had earlier this year. So the wide gap between the tech and the Dow makes perfect sense if you look at the economic factors.
I think the markets are anticipating that the interest rate hikes are going to kind of level off and might actually start trending downward in the next couple of years. Tech tends to be extremely sensitive to interest rate hikes because most tech companies don't pay a dividend. And when you're getting nothing you're coming your way, and all these pundits are talking about recession, people would prefer getting higher interest from CDs and treasury bills and bonds or even dividend paying stocks and getting nothing while impending doom is headed their way. Second thing, and which Alex alluded to, is that NASDAQ got hammered in 2022 relative to the Dow. If you think about it, if the NASDAQ theoretically were to drop 50% and the Dow Jones Industrial Average were to go up 5%, and then the next year the NASDAQ goes up 95%, but the Dow only goes up 5%, you're way better off being in the Dow than you would have been with a 95% rally in a index that dropped 50% the previous year. So those kind of numbers don't really impress me. What impresses me are long-term returns based on discipline.
Yeah, so if you follow like VYM, which basically has a lot of the Dow stocks in it, it was only down about what was it? Like it was like down like down 0.46% at the end of 2022 relative to the S&P 500, which was down 18.5% on a total return basis. So the fact that it's getting beat this year is not, it's not that concerning, because I'm sure everybody, yeah, like Joe said, I think people's expectation is that the Federal Reserve is going to they're going to pause now on rate hikes, and I think what they're seeing is that it's only they may even be cutting rates by the end of the year. And I think that was actually JP Morgan's official estimate, is that you would actually start seeing rate cuts by September, given the last retail sales data, which I think was lower than expected. And so so you're starting to see, all right, so maybe we're not going to be in this high interest rate environment, so people pile into tech. And then you also have what Drew says, absolutely right. As of March 8th, and I remember this because I was on vacation and I was watching my phone blow up, that the banking sector was having a bunch of issues. And yeah, that's when the Dow started severely underperforming the S&P 500 and the NASDAQ. But over the last 12 months, I mean, they're pretty much on par with each other, and markets change quickly. So if you're if you're a short-term trader, this is an issue for you. But if you're invested for 10 to 15 years, this is just a blip on the radar. And markets go through these things. Like sometimes the Dow does better, sometimes the NASDAQ does, sometimes the S&P does. It just all depends on what's going on in the world, and they all ebb and flow. And this is just part of being an investor.
I think it's just human tendency to get interested whenever a new record is set or a new trend is broken or there's a disruption in the patterns. When we set a new record high or a new record low in terms of weather, people get really interested, they get excited, they get concerned, and they start to peek under the hood. Well, why? Is it climate change? Is it just natural occurrences? What's going on? So I think that's what folks are doing right now. Not a crisis. It makes perfect sense, but people do get interested when these things happen.
And it gives people at the Wall Street Journal jobs.
Right.
But it is interesting to know. So, okay, let's see here. So the IRS is set to release a report this week on the feasibility of a free government-run tax filing service as part of an effort by the Biden administration. But companies like TurboTax and H&R Block have spoken out against the initiative, which would allow Americans to file directly with the IRS and forego accountants and private companies like TurboTax that typically charge a fee. Do you think the government should be in the tax preparation business?
Yes and no, in the sense that I don't think anybody should be in the tax preparation business. Most other developed countries, whatever their version of the IRS is, sends you a bill, and you pay the bill. So this is best explained by a meme that goes around during tax season every year, and it's the government knows exactly how much money you owe to them. They're not going to tell you what that number is, and you either have to guess the number or pay someone to guess it for you. And if you guess it wrong, you go to jail. It's a really, really stupid system. And the IRS has all the information already. You have to fill it into a form and send it to them again. And if you get it wrong, you end up, like I said, either going to jail or facing fines and all kinds of problems. The IRS already has the information. They should send you the bill. If you notice something wrong, correct it. Otherwise, you pay it. There should be no tax prep industry. It's ridiculous that there is one. And of course, they are lobbying against this. They make billions of dollars doing it. Americans spend 6 billion hours doing taxes every year and hundreds of millions to billions of dollars on tax prep. It's ridiculous. Total waste of money. I say get rid of it entirely.
I'm not a fan of the current income tax system as it is. So a new platform to file doesn't get me very excited, especially when it's coming from the government. When the government uses the word free, I like to, it's almost like a 4-letter word to me. Nothing is free. So I want to know, what cost is this going to come to, and who is it going to come from? If it doesn't cost much to create or run, then I guess I really don't have a problem with it as just being another option. I don't like paying fees to file taxes, but I do like having options. Someone can use the free government site. Someone can pay a little more for TurboTax, or they can pay a premium for a tax preparer or a CPA. This seems fine to me. So as long as the government option is just an option and it doesn't become a mandate, then I don't really see a problem with adding it to the mix.
When I was in the Marine Corps, I always marveled at how much profits Burger King made on military bases when they had free dining facilities on the base. And I think the point is that if TurboTax and some of these other tax preparation companies are really, really good at what they do, they have nothing to worry about because they're competing against the government. So if the government can actually accurately predict what your tax liability is, then it's a good deal. I don't think that's going to happen. So if TurboTax is good, their business is probably going to proliferate when people start migrating from the free platform to the TurboTax, because TurboTax actually saves them more money. If they can't, then who cares?
Now, I was 100% in agreement with Alex, is that if the IRS is going to start a tax preparation business, why don't you just take it one step further and just do the tax preparation? You're already doing it. Just open the door up so we can see what you've done, send us the bill, and then we can, a lot of people can, I'm sure, and I don't think it means that accountants are going away and like TurboTax. I'm sure there's a lot of people who are going to want to confirm that data, and a lot of people who are going to want to argue with the IRS about whether they did it right. But honestly, just send a bill. They do it in Australia, and I listened to a Planet Money podcast about Australians who come to America, and they're like, what is this thing that we have to do, file our taxes, because they already have the information, but they're making us do it anyways. Yeah, so it's like a test, and if you get the answer wrong, like Alex said, you go to jail. So I don't know. I just say it's like, all right, fine. The IRS wants to do it. I guess you might as well just file it with a source, but just take it one step further. Just do it, and then we can all just go play golf or something like that. And if you want to argue with it, argue with it. There'll be accountants around, but yeah, I don't know.
There'll be good accountants around.
Yeah, exactly. All right. Okay, so this might be an issue with the new IRS thing too, but so hot desking, where employees don't have an assigned desk but grab an empty one on days they come into the office, seems like a cost-saving no-brainer, because you don't have to have like offices and like assigned computers and all that kind of stuff. People just come in, they grab whatever's available. And this is according to the Gensler Research Institute, who did a 2022 U.S. workplace survey. They found that 19% of the office workers who responded had an unassigned workspace compared to 10% in 2020. So hot desking has gone up by about 10% over the last couple of years. There's just one problem though. Many employees hate it. They complain about the nuance of having to hunt for a workspace every day when they're in the office, not being able to find a station that suits their needs, and no longer having a permanent space that they can personalize. Collaboration is harder, they say, and they feel less connected to their colleagues. Do you think employees' feelings about hot desking are valid, or are they just finding this something to complain about?
Yeah, I think this is another really weird, inefficient system that seems to be introduced for no good reason. I mean, if you're going to make everybody pack up their stuff and take it home with them every single day so that they can bring it back to an office and hunt for a desk, I mean, why would you not at that point just have them work remotely? If you want them in the office to collaborate, then assign them a desk and put them in the groups to make collaboration easier. I don't see why this would help anything or anybody. It just seems like all it does is introduce a bunch of complication where it's unnecessary.
It sounded like it came from good intentions. They're trying to promote efficiency, I guess, or trying to get different employees to interact with other, team building, that kind of thing. But I think the answer is in the results of the survey. Employees don't like it. Do away with it if you want your employees to be happy. It does sound kind of awful. I wouldn't want to work in a place with hot desking. That sounds like a mess.
This sounds like a dad that just got to the office after his kids were fighting over something at home, and they said, either you solve this problem or I'll solve it for you. And then when he gets to the office and he hears a bunch of bickering amongst his employees on so-and-so has a nicer desk than I do, and so-and-so gets to sit next to a window when I don't, and how come I have to be next to the coffee mess where everybody has to go by my desk and talk to me when I'm trying to get things done? So he said, fine, I'll fix it for you. Everybody has to switch the desks, and whoever gets to work first gets the best desk. And that's how this came to be, because I can't imagine that this came on its own. Like a bunch of experts with feasibility studies came to the conclusion that this was a good idea.
Yeah, I don't know. I have a hard time with it because I've also heard complaints that employees tend to underperform when they're in the same desk day after day after day. They say there's no change. So I don't know. I feel like this is just people might be just overthinking it. But I understand like where they're coming from. It's kind of annoying. I feel like people will assign themselves a desk anyways, but I don't know. I just assign people a cube, I guess. I don't know. I don't think it's that big of a deal though.
Dan, I think your comment on having a desk right next to the coffee mess, I think Tom felt that one a little bit. Every time I get a cup of coffee, I go chat with him, and every time I'm out there, Erica's getting a cup of coffee and chat with him. I don't know how he gets any work done. But,
very, very chatty in here.
Yeah.
All right. Oh, I used my 1 second. Dang it. All right. All right.
Yeah, I'm
All right.
empty too. So
Yeah. All right. So early. So who? All right. So this question is basically for Drew and Joe. So early career professionals prize their work-life balance, but it turns out they're bad at it. So the youngest people in the office say their peers. The youngest people in the office say the peers they most admire carve out personal time and live life on their own terms. Fancy titles and fat salaries are less impressive, according to an annual survey done with millennials and Gen Zers that was shared with the Wall Street Journal ahead of next week's release. But many millennials fail to put these beliefs into practice. So many millennials are basically saying that they prize work-life balance over fat paychecks and fancy titles. But it turns out, they say that, but not a lot of them actually put this into practice. Why do you think that is?
This is getting so annoying. The whole work-life movement. I think it all stems from social media. Millennials are watching TikTok videos or Instagram or whatever it's called these days, and they're like, "Oh, I want that work-life balance." And then they see another video and it changes their opinion. Just do what's right for you. Balance is good, and just work on finding your own balance in your particular life. Don't get this influence from everyone else. It's just going to mess you up.
I think the struggle is that it's really, really hard to get wealthy without working. And that if you work less, you make less. But if you work more, you make more. So you feel this tension between wanting to be home watching The Office reruns on Netflix, or making money. And it turns out that you got to be at the office to make money. And that balance is constantly doing this until you get to a point where you actually have enough to meet your actual needs. And to Drew's point, social media, everybody's comparing how they're doing financially to everybody else. So I don't see where millennials are getting it wrong. They certainly seem to be doing it a heck of a lot better than my generation or my parents' generation did in terms of work balance.
Are we happy though? Doesn't seem like it.
You three seem happy. I mean, compared to now, I agree that a lot of your peers, but are
I'm
unhappy.
speaking in terms of peers, yeah. As you know, as the article stated, not me, Tom or Alex, but
Maybe we should do a show on why you three are happy.
yeah, maybe.
Maybe a deep episode. All right. Well, everybody's out of time, so I guess technically, Joe. I don't even know who won today. I mean.
Oh yeah, you're gonna rob me of my victory.
Well, technically, you're in the hole by 18 seconds. I mean, you were winning, and then now you're 18 seconds in the hole. So I don't even do that. So I guess there just are no winners today.
Yeah.
Sad. So
I'm cool with that.
We all get
If I can't win, then there's no winner.
All right, that's it for episode 82 of Farm to Markets. We'll see you next week.